Ever feel like you're just swimming in financial news, wishing you had a way to get the real story without, getting totally overwhelmed? Well, you've come to the right place.
Welcome to the deep dive. Today we are plunging right into the Forex markets. It's complex, it's fast-moving, and we're focusing specifically on the U.S. trading session for July 11th, 2025. Our mission, simple, really. We're taking this huge pile of data news, central bank stuff, economic calendars, even where the big institutions are placing their bets and boiling it down, giving you just the critical insights you need. So let's start big picture. What's the main current pulling everything right now? Absolutely. And it's pretty clear. The dominant narrative today is a significant step up in global trade tensions, primarily driven by recent U.S. actions. And this aggressive stance has really shifted the market's focus. Forget economic recovery for a moment. It's all about defense, about risk aversion now.
Okay, so escalating tensions, risk aversion. Let's unpack that. What are the specific moves driving this? I mean, it feels a bit like deja vu with trade wars, doesn't it? What are the actual tariffs and how's the market, reacting on the ground?
It really does feel like that. So our sources are confirming the U.S. just announced a pretty steep 35% tariff on all Canadian imports. That kicks in August 1st. And that's not it. There's also a 50% tariff slapped on copper imports, plus explicit threats of more levies. Things like semiconductors, pharmaceuticals, targeting the EU, Japan, key partners.
Wow. Okay.
And this kind of thing, as you said, it pushes markets straight into that risk-off mode. The reaction, it's been textbook, really. A flight to quality, flight to safety. The U.S. dollar index, the DXY, it's climbed to around 97.80. Investors want safety, liquidity.
The dollar, yeah.
And the Japanese yen, too. Seeing significant safe haven flows. That's pushing pairs like USDJPY, CTADJPY, and Wall Street. It looks resilient on the surface, maybe. But our data suggests it's more like shaking off concerns, not ignoring them. The VIX, the fear index, is still up a bit, 15.78, moderately elevated.
That makes sense, that feedback loop. So tariffs spark risk off, which strengthens currencies like the dollar and yen.
Yeah.
How are the central banks responding? Are they all singing from the same hymn sheet here?
Oh, definitely not. It's creating this matrix of deepening divergence between them. Take the Federal Reserve. They're holding their target rate steady for now, 4.25% to 4.50%. But look inside their June meeting minutes. Significant division.
Really?
Yeah, some members are actually open to a rate cut, maybe even this month, July, specifically because of these trade tensions. Others, still hawkish, worried about inflation from the tariffs.
Oh, okay, the flip side.
Exactly. So this internal conflict means the Fed's basically in wait-and-see mode, highly data-dependent, especially on upcoming inflation numbers.
Right.
Then you've got the European Central Bank, complete contrast, they've already eased, cut their deposit rate to 2.000% back on June 5th, and they explicitly said uncertainty surrounding trade policies was a key reason.
So that puts the euro
at a fundamental disadvantage, especially against a strengthening dollar.
Makes sense. And the Bank of Japan.
Still the most accommodative. Policy rate just 0.5%. And they're in action. It's tied directly to this global trade mess. They're also waiting and seeing. But the fascinating thing for the yen is this conflict, right? It's strengthening because it's a safe haven.
Right.
But it's also being pulled down by that huge negative interest rate differential. Japan's rates are super low compared to others.
Right.
Makes it less attractive for yield-seeking investors.
Okay, tariffs, diverging central banks. Got it.
Now, looking ahead just today, what are the absolute crunch points, the data releases that you think could really shift the needle?
Yeah, definitely keep an eye on two big U.S. releases in the next 24 hours. High impact. First, 8:30 a.m. Eastern. That's the U.S. Consumer Price Index, CPI.
The inflation number.
Crucial.
Absolutely critical. The market's going to be laser-focused. Are these tariffs showing up in consumer prices yet? If CPI is hotter than expected, validates the Fed hawks, probably boosts the dollar.
And if it's soft,
supports the doves. Could weaken the dollar. Then later today, 2:00 p.m. Eastern, the FOMC meeting minutes.
But we know the outcome of the meeting already, right?
We do. But the details in the minutes, they give crucial insight into how deep that internal debate about tariffs, inflation, and growth really goes. Any subtle change in language, any nuance, could spark some real volatility late in the session.
That makes a lot of sense. Okay, so with all this macro stuff swirling, the tariffs, the central bank splits, upcoming data, how are the big fish positioning themselves? The institutional investors, the smart money, what are they doing?
That's a vital piece of the puzzle. And the Commitment of Traders report, the COT report, gives us a good glimpse. Looking at the U.S. dollar index, the DXY, we see significant net long positions, both asset managers and those leveraged funds.
So they're betting on more dollar strength.
Exactly. It confirms they expect the dollar to keep climbing. Lines up perfectly with the safe haven flows, that policy divergence we talked about.
Okay, what about the euro?
Almost the mirror image. Substantial and growing net short positions among institutions.
Selling the euro.
Right. It directly reflects that widening policy gap.
Mm.
ECB cutting, Fed maybe holding or even hiking down the line, makes the euro less attractive to hold for these big players.
And the yen, you said it was conflicted.
It is. The positioning is complex. Speculative accounts are net long, yeah, for the safe haven aspect, but it's not extreme.
Because of the low interest rates.
Precisely. That negative yield caps the enthusiasm a bit.
Okay. Australia, Mexico.
The Australian dollar. Decidedly net short. Institutions are betting against it, driven by RBA rate cut expectations and its sensitivity to global risk, especially China.
Yeah.
And the Mexican peso. This is a dramatic shift.
Oh.
Leveraged funds have aggressively flipped. They were long the peso, now they are significantly net short.
Why the big change?
It tells us carry traders, the ones borrowing cheap to invest high, are bailing out fast. Because of the escalating geopolitical risks and these tariff threats, they're abandoning the peso trade.
Wow. Okay, so we've got the big picture, the central banks, the data, the institutional bets. What does this boil down to for specific currency pairs? We've dug into 5 that seem to tell the most interesting stories right now, using a weighted system, volatility, sentiment, even social media buzz.
Exactly. And if you connect these back to everything we've discussed, each pair really gives you a unique window into how the market's processing all this. They really show the forces at play.
All right, let's start with Euro-USD. We're calling it the policy divergence epicenter. What's the story?
Yeah, USD. The projected trend here is clearly bearish. And the convergence, it's exceptionally strong. All 5 layers of our analysis, technicals, fundamentals, sentiment, everything are pointing down.
Unanimous?
Pretty much the intriguing details. Well, that huge policy gap, right? Fed at 4.25, 4.50%, ECB down at 2.00%. Technicals show a clear descending channel. Primary downside target around 1.1609, maybe 1.1642.
Yeah.
Institutional whales, heavily net short the euro, confirming their bets. Our AI simulations, Monte Carlo, project a strong drift down towards 1.1650.
So confidence is high on this one?
Very high. Confidence score is a 9 out of 10. We see the potential price zone between 1.1610 and 1.1710 way.
Okay, next. GBPTPY, nicknamed the Dragon, sometimes the Widowmaker, sounds dangerous. Why is it the volatility crucible of today?
Yeah, it earns those nicknames. It can definitely bite. And today shows why lots of conflicting signals. This pair is a real battleground. The projected trend. We're seeing sideways weekly bullish. The convergence is weak, weekly bullish, because of these big forces pushing against each other.
Like what?
Well, pulling it up is the powerful carry trade. Bank of England's rate is 4.25%, BOJ is 0.5%. That big difference is attractive.
Right, the yield hunters.
Exactly. But pushing it down is this massive psychological resistance level at 200.000, plus the whole fragile global risk move because of tariffs. And interestingly, retail traders, often a contrarian signal, are 60% short this pair.
Which suggests maybe a move up?
It can, yeah. It's a contrarian bullish signal. Our simulations show a high chance of retesting that 200.00 level, but also a significant risk of a sharp rejection right there.
So less certain on direction.
Much less. Confidence score is only a 5 out of 10. The potential price zone looks like 197.5 to 199.8 year. It could chop around in there.
Got it. Moving on to AUDJPY. The Global Risk Barometer. What's the read here? It often tracks global sentiment, right?
It does. And for AUJPY, the projected trend is sideways, but with a bearish skew, leaning downwards. The tricky part is the convergence is highly divergent. That's a classic warning sign.
Divergent how?
Well, the price just hit new 5-month highs near 97.00. Indicators like the RSI are screaming overbought. Statistically, it's stretched, suggesting a pullback. But here's the crucial insight. The smart money, the institutions, they're holding significant net short positions in the Aussie dollar.
So they're betting against this rally.
Exactly. It's a stark contrast to the recent price action you see on the chart. It strongly suggests this rally could be a bull trap.
Looks strong but could reverse hard.
Precisely. So our directional confidence score is low, a 4 out of 10. We see the potential price zone is 95.2 to 96.80, likely pulling back into that range.
Okay, fascinating. Now, USDMXN, the geopolitical bellwether. You mentioned the dramatic shift here earlier.
Absolutely. This one's story is clear right now. It's bullish. We're seeing strong convergence across all our analytical layers towards that bullish outlook.
What's driving it?
The intriguing part is how it's pivoted. It used to be a carry trade favorite. Now, it's all about geopolitical risk. The long-term downtrend looks exhausted. We see strong bullish divergence on momentum indicators. The core driver, those U.S. tariff threats against Mexico, and Mexico's potential alignment with BRICS nations.
And the institutions dumping the peso.
That's the confirmation. The whales flipping dramatically net short the peso, abandoning the carry trade. Our AI simulation, over 70% chance of breaking above 18.85.
So high confidence here too.
Yes, confidence score is an 8 out of 10. The potential price zone is 18.65 up to 19.15.
Right. And finally, USDCNH, the offshore yuan, the trade war barometer. What's the outlook?
This is maybe the purest expression of the U.S.-China trade conflict. And right now, the projected trend is sideways, but with a volatility breakout imminent.
Sideways, but ready to move.
Exactly. The convergence is highly divergent. No clear directional agreement at all. The key detail, the pair is coiling, stuck in a really tight range, roughly 7.1630 to 7.19 MTRO. That indicates deep compression, low volatility, often the calm before the storm. Fundamentals lean maybe slightly bullish because of trade risks. But retail traders, they're 63% long, which is a contrarian bearish signal. But here's the critical piece. Institutional whales. They're not betting on direction. They're accumulating non-directional option strategies.
Like what?
Straddles, strangles. Strategies that profit from a big move up or down. They're betting on a large increase in volatility itself.
So they expect a breakout, but don't know which way.
Precisely. So our directional confidence score is very low, a 3 out of 10, but we're confident volatility will spike. The potential price zone remains that tight 7.1630 to 7.1900 for now.
Okay, wow. We've covered a lot of ground. From the macro trade tensions down to these specific pairs and how the big money is playing it. So what does this all mean for you, the listener? How can you actually use this kind of deep dive?
Well, the goal here is to give you that clear, concise briefing, help you assess the landscape, figure out where the higher conviction setups might be versus where things are really uncertain, and apply risk management accordingly. It's about cutting through the noise, basically, making more informed decisions in a complex market.
Can you give us a concrete example, like using that highest conviction setup you mentioned, the Euro AZC short? How might someone approach that based on this analysis?
Sure. So for a USD short strategy, given that strong bearish convergence, the rationale is clear. Look to potentially sell if the price bounces up intraday into resistance. A common approach might be to look for an entry around 1.17 over 0. That's often near a daily pivot level. Can be a good spot to enter at a minor bounce. You take profit, maybe target 1.1600. That's just above that critical support zone we identified around 1.1610, 1.16107.
Okay. And crucially, the stop loss.
Right, risk management. A typical stop loss might go around 1.1740. That's above a key resistance pivot, protecting you if the bearish structure breaks down significantly. And that setup, roughly speaking, gives you a favorable risk-reward ratio, about 2 to 1. You're risking, say, 40 pips to potentially make 80 pips. That aligns well with the strong bearish outlook.
That makes sense. A practical application of all the layers we discussed. Okay, so we've navigated the complex currents today. Escalating trade wars, central banks pulling in different directions, the institutional money flow. It's a lot, but hopefully piecing it together helps you understand what's really moving global finance right now. And here's something to think about. In this world where trade tensions are actively reshaping economies, how might these direct targeted tariffs start hitting supply chains and hitting consumer prices, maybe in ways the central banks haven't fully factored in yet? And what new opportunities or maybe new risks could pop up from that evolving picture? Something to chew on. Until next time, keep digging, keep asking questions, and stay curious.